Hey everybody, this is Logan Alec. I am a CPA and real estate investor. Just want to give everybody a quick presentation on the effects of tax reform on real estate investors. This is something of personal interest to me as a real estate investor, and as the majority of my clients are real estate investors or touch real estate in some way, shape, or form in their business. I thought it would be great just to put together this presentation to go through with y'all. So here's me. Like I said, I'm a CPA. I am also a real estate investor and a personal finance blogger. You can book me for a free CPA consultation at alexcpa.com / free 30. There's the link right there. Like I said, also a personal finance blogger. This blog called moneydoneright.com, it's been a great source of passive income for Caroline and myself, and it's somewhat enjoyable as well. Go to moneydoneright.com. We have a sign up there where you can learn how to make your own money-making blog and all that. So anyway, let's get into it. Who is this for? This presentation is for landlords. You have rental properties, whether it's just one or two units, or whether you own big apartment or commercial buildings. It's for flippers. Those of you who take an old dumpy looking house and fix it up and make it new and make a big profit off it. This is for agents or brokers, those of you who transact real estate and facilitate those transactions, and it's for anybody else really who touches real estate in their business. Wholesalers, syndicators, there's something in here for you as well. So first and foremost, let's go over the basics of tax reform. You got to start somewhere. You may not know this, but when President Trump signed the tax bill into office, he claimed that this is the biggest tax cut, the biggest tax reform of all time. Probably not true. Might need some fact checking on that. That might be the so-called alternative facts, but needless to say, this is a pretty big deal. Most Americans will see a tax cut across the board. Not only businesses, but also just everyday folk like you and me as well. So let's get into the basics. This is a rough outline of what we're going to go over today. We're going to talk about tax rate changes. We're going to talk about the changes to the standard deduction and personal exemptions. We're going to go through the new pass-through deduction. We're probably going to spend the most time here because not only is this probably the most confusing aspect of tax reform that affects people in the real estate industry, but it's also probably one of the most beneficial items of tax reform for them. So we're going to camp out here for a while. Then we're going to talk about depreciation. There's some beneficial things there. Meals and entertainment, there's some unbeneficial changes there. We're going to talk about changes to mortgage interest and state and local property taxes, that itemized deduction. You guys have probably heard about this in the news and the media, so we're not going to spend too much time there. We're going to talk about the changes to the miscellaneous itemized deductions. Then we're going to talk about 1031 exchanges, pretty huge changes to AMT, very beneficial for myself and probably for many of you as well. We're also going to talk about some random stuff there at the end. So tax rate changes. So across the board, for most folks, in most of these taxable income levels, marginal tax rates went down for pretty much most Americans. So you can see, the lowest bracket remains 10%. There's this new 12% bracket, right, that kind of replaced the 15% bracket roughly, or almost exactly. Then before we went straight from the 15% to 25%. Well, now we got this 22% and 24% bracket, and the 24% bracket extends pretty deeply into where the 28% bracket used to lie. And then we have kind of these poor souls here in this bracket range here, and this is for singles, by the way, this chart. Their marginal tax rate actually went up to 32%. So interesting enough, then there's this small bracket here. It kind of went back down, and then for this pretty large bracket here, right? So a lot of folks, probably a lot of you, single folks out there who are, in a profession or your own business, you might be in this bracket. So it's actually a slightly higher marginal tax rate, but There are some other deductions and things, right? Especially if you're self-employed, that will actually probably make your total tax burden, a lot lower than it was, even though your marginal rate might have gone up a little bit. For this very small kind of range right here, the rates remain the same, and of course the top bracket, the folks who used to be in the highest bracket saw a rate reduction as well. Kind of the same for married folks. There's kind of a similar story. Lots of these brackets or these kind of ranges saw tax rates decrease. An interesting thing about kind of the way that tax rates have shifted are that the marriage penalty that used to exist under the previous tax brackets has been scaled back significantly. So, just to give an example of what the marriage penalty is, let's say you have two people, right? And in 2017, they each made $150,000, right? So you can see here that individually their marginal tax rate would be in the 28% bracket, right? So they each make $150K. I mean, let's say that's after deductions and everything. If they made $1 more of income, they would pay 28 cents in federal income tax on that dollar, right? Individually making $150K each. Well, let's say they get married, right? Okay, now their combined income, and there's other calculations with deductions and things like that, but kind of like setting all that aside, let's say that they're married and, now their combined income is $300,000. Well, look, instead of being in the 28% bracket, they're now in the 33% marginal tax bracket. But, lo and behold, under tax reform, those singles, right, would have been individually in the 24% bracket, making $150K. And let's say they got married, they would actually be in the 22% bracket. So, the marriage penalty, which usually affected, folks, making healthy middle class income, maybe, young professionals, young business owners, kind of in that 100K to 200K range a piece. They get married, now they're paying more in taxes, right? So that has actually been scaled back significantly. Now there's oftentimes a marriage benefit, for folks that were previously subject to the marital penalty. Now, for folks who make significantly more money than that, there's a marriage penalty does still exist. Now we can kind of by way of example, let's say let's say two singles made $400,000 each, right? So you had single person number one made $400,000. Where am I going here? So single person number one made $400,000, right? They'd be in the 35% bracket here, right? This is the range here. Their marginal rate would be 35%, each making $400,000. Let's say now they're combined. Oh, they're making $800,000. Now they're going to be combined in 37% bracket. So the marriage penalty does still exist, but it's for what I would call very high income earners now. People who are individually making probably over 350K a piece, and those types of folks get married. So I think that's enough about tax rates. Now let's talk about the standard deduction and personal exemptions. So here are the standard deduction amounts. Now, if you've ever looked over your tax return before, that how it basically works is you add up all your money, what you made, your wages, your interest, your dividends, your capital gains, your rental real estate income or loss, your self-employment income, your income from K-1s, and you get an amount, right? Let's say it's $100,000, just for as an easy example. And then previously you got these things called personal exemptions. For yourself, your spouse, and your dependents. And then, below that, you got this standard deduction, right? Or itemized deduction. So everybody gets this standard deduction, right? But if you own a home, if you give a lot to charity, if you pay a lot of property or state taxes, you can add up all those amounts, right? And if it's more than these standard deduction amounts, you can use that amount, right? So by way of example, let's say you have $10,000 in mortgage interest in 2017, and you paid, $10,000 in property taxes in 2017. So the combination of those two amounts are $20,000. And, let's say you're married. You would take you would use that calculation, that itemized deduction calculation, where you add up your individual deduction amounts because it's bigger than this $12,700 amount. So you want to take the bigger amount and reduce your taxable income by that amount. Now, in 2018, they basically doubled the standard deductions almost across the board. So, if you're paying $10,000 in mortgage interest and $10,000 in property taxes, well, that's only $20,000. You don't hit this $24,000 married filing joint standard deduction. So you're actually going to take the standard deduction, and those amounts that you actually paid in for property taxes and mortgage interest doesn't really matter for taxes anymore. So, depending on how you look at it, you might like this, you might not, but as a result of this, we see, a pretty big boon for folks who maybe weren't homeowners, maybe, they didn't give a lot to charity, because now they're going to see a lot more deductions, just for being alive. So, in 2017, probably 30% of taxpayers, as they do their 2017 tax returns right now, will be itemizing their deductions. 2018, only 6% are estimated to itemize their deductions. So, thanks to this increased standard deduction, that's far fewer people will be itemizing. So kind of a little tax tip here. If you're going to be one of these folks who, are going to be taking the standard deduction, right? As an itemized deduction, your home cost, your home mortgage interest, your property taxes don't really count anymore. Think of ways you can get some of, your home mortgage interest and property taxes off of your Schedule A as an itemized deduction and onto other schedules, Schedule C, which is like self-employment income, Schedule E, which is, rental real estate. And, examples of this would be like a home office, right? Start a side business, right? Have a space in your home that you use regularly and exclusively for that business. And, you can write off some of your mortgage interest and property taxes that way. And it won't impact your standard deduction. If you're married, you're still going to get that $24,000 standard deduction, but you're getting these other additional home-related deductions you can count against your business. If you want to move some of this to Schedule E, Airbnb, Airbnb a room in your home or just rent out a room in your home, right? Because, now you can, take some of that mortgage interest and property taxes and no longer call it a personal expense that you have to treat as an itemized deduction, but now it's a rental expense. In the case of a rental, or it's a business expense in the case of your home office. Another big change, personal exemptions have been eliminated. So, in 2017, this was another kind of deduction everyone just got right off the bat. They got about a $4,000 50 deduction, right off the bat. So, for themselves, for their spouse, and for their dependents. Well, they got rid of that with tax reform. And the thinking is that the increased standard deduction that we talked about and the expanded child tax credit that we're going to talk about next will kind of make up for, getting rid of these personal exemptions. So the child tax credit, big changes there. So in 2017, the maximum credit was only $1,000. That's doubled per child. In 2018, that's doubled to $2,000. And to be honest, the child tax credit phased out pretty quickly under the old tax law. If you were married, you couldn't take it if you made more than $130,000. But 2018, you can take it even if you make up to $440,000. So there is a phase out. So when you see phase out, we're going to talk about phase outs a lot in this presentation. It means, like, for example, the 2017 phase out for MFJ or married filing jointly. That means that, once you start making over $110,000, this maximum credit is going to be reduced a little bit. For to the extent you make more than $110,000, and it goes away completely, right, after you hit this point. But these phase out amounts are, have increased a lot for 2018. So married filing jointly, kind of the top income went from 130 to 440 of people who can still take the credit. Single went from 95 to 240. Married filing single or married filing separately went from 75 to 240. So that's pretty cool news. Okay, I think this is enough about the these kind of basic kind of individual type stuff. Now let's talk about kind of the big guy here, the pass-through deduction under Section 199A. So, what is this pass-through deduction? Who gets it? How do you take it? And kind of all that. We're going to get into that. But let's first kind of talk about the basics, and we're going to define some of these things like pass-through business. But the essential point of this pass-through deduction is a pass-through business may get a 20% tax deduction on its bottom line. So, okay, what's a pass-through business? I'll tell you. A pass-through business is basically any business that is not taxed as a C corporation. Okay, so you're a sole proprietor. You don't have a business. You just went to the county and got a DBA, right? And you're selling widgets out of your home, or you have some e-commerce site. You're a pass-through business. You're a real estate agent, and you have an S corp. Okay, you are a pass-through business. You're a landlord and you actively, you're participating in your rentals, and you report them on your Schedule E, or you hold them in a wholly owned LLC. You're a pass-through business. So, just to kind of give you an example here of how this works, let's say, you're a sole proprietor and you have a business and your gross revenue is $200,000. You spend $50,000 on, your expenses. So your net profit is $150,000. So what's your pass-through deduction? Well, it's this $150,000 times 20%. That's a $30,000 deduction. That's pretty cool. So even though you netted $150,000, which is what you would have paid tax on, in 2017, now in 2018, thanks to tax reform, you're only going to pay tax on that $120,000. So, if you're thinking about starting a side business or going self-employed, I mean, this is a great incentive to do it. Now, what this doesn't take into account is self-employment taxes, which, as you know, self-employed people do have to pay. And there are ways to mitigate that, such as by setting up an S corporation and some other strategies that we're not going to talk about here because it's not really tax reform specific. But if you want to talk about those strategies with me, you can book me, of course, at alexcpa.com/free 30. So let's walk through this example. This example here that we gave, 2017 versus 2018. So like we said, this individual, he or she makes $150K. That's their adjusted gross income, right? They have the $200K revenue and the $500K expenses. So their net is $150K. And let's say this is all they have. So in 2017, they'd get the $6,350 standard deduction as a single person. They'd also get the $4,050 personal exemption for themselves. So they'd have $139,600 taxable income. And if you run through the tax calculator, how much actual federal income tax is that? That's a $32,000 tax liability. Let's look at 2018. AGI, $150,000. Okay, 20% deduction, $30,000 deduction right off the top. Standard deduction, $12,000 standard deduction that got doubled. They got rid of the personal exemption. Taxable income, $108,000. If you run that through the tax calculator for 2018 with the new tax rates, the new lower tax rates, this individual federal regular income tax liability only about $20,200. That's almost a $12,000 tax savings. That is pretty incredible. Of course, this doesn't take into account the self-employment tax, but theoretically, that would be somewhat the self-employment tax itself would be constant. Between these 2 years, if they're subject to the self-employment tax, because this deduction doesn't count against your self-employed tax base. And there'd be some kind of difference because you get a deduction for half of the self-employment tax paid, but that's kind of a minor complexity there. What I want you to take away from this slide is that if you have a pass-through business, and subject to certain restrictions that we're going to talk about in a little bit, you're going to be paying a lot less in taxes in 2018 than 2017. Most likely. This depends on your situation, of course. Check with your tax professional, but in this kind of standard, typical example, this is the kind of savings we're looking at. Now, what if you're a W-2 employee, right? Do you get as big a tax benefit between 2017 and 18? No, not quite as big, but you still get some benefit here. I'm not going to walk through everything, but this W-2 guy or gal, right? They make $150K, they're single on their W-2, that they're still looking at some pretty cool savings there. So A question that I hear a lot is, do you have to set up an LLC or some other, business entity to take this deduction? The answer is no. You can take this deduction even without an entity. You're a sole proprietor. You just report everything on Schedule C. You don't have an entity, or you have rental real estate and you just report it on Schedule E. You don't have an LLC. Now, this isn't to say that you shouldn't, set up an LLC or something. And I hope those of you who are investing in real estate, that you've talked to qualified attorneys about whether or not that makes sense with your particular situation. So all in all, this pass-through deduction sounds pretty cool, right? I think we'd all agree that we all like saving, paying less in taxes. But is there a catch? And the answer is yes, there is a catch, and there are two catches actually. But here's the thing. Here's the cool thing, guys. The catches do not apply if your income is below $157,500 and you're single, or $315,000 and you file jointly with your spouse. So if your income is below these amounts and you have a pass-through business, you can take the deduction based on your pass-through income. Period. You're not subject to these catches. However, if you make more than these amounts, okay, if you make more than $157,500 as a single person, or $315,000 as someone filing jointly with their spouse, there's some extra kind of brain damage you have to go through and think about when it comes to these deductions. So the first catch here, you can't be in a specified service business. Okay, if you make more than these amounts right here, your pass-through deduction gets reduced if you're in a specified service business. And in fact, you cannot take the pass-through deduction at all if you are in a specified service business, if your income is over $207,500 as a single, or $415,000 for married filing jointly. Natural question, what is a specified service business? Specified service business is any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners. Let's go through some examples. This isn't live, so can you think of any examples? Think of some. Can you think of any examples of businesses where the principal asset is the reputation or skill of one or more of their employees or owners? Going to skip that. So examples kind of in the tax code itself: health, law, consulting, athletics, accounting, entertainment. So that first one, health, right? Let's say you're a physician. You have a pass-through business and you have a medical practice. What is your primary skill, or what is the primary asset? Sorry, so answer is the primary asset is your skill, right? It's your knowledge. You went to medical school, or you went to university, you studied biology or some, scientific, major. And then you went to medical school, and then, you did a residency, and, you might have done a fellowship or some other kind of, advanced kind of thing. And so, you spent years, many years and many dollars acquiring this skill and this knowledge. That is your primary asset of your business. Sure, you might have some equipment, but at the end of the day, your primary asset is your skill, right? And this is kind of going back to the definition, right? The principal asset of your business is your reputation or skill. It's not only your skill, but it's also your reputation as a physician, right? So same thing with attorneys, same thing with consultants. If you're an athlete, obviously your primary asset is your skill. Same thing with accountants, same thing with entertainers. So, there are exceptions to this general kind of rule, right? Businesses where the principal asset is reputation or skill. One would say that probably engineers and architects fall into that bucket, but they got an exemption. They're an exception to the rule, and they were originally in there, I believe, but their lobbyists must have done a pretty good job of getting them out of this definition of a specified service business. But, if you are in any of these fields, for sure, health, law, consulting, athletics, accounting, and you make more than, these amounts here, you cannot take the pass-through deduction, and you get a limited deduction if you make more than these amounts but less than these amounts. So Let's go through some real estate specific examples. We're going to ask ourselves, is this a specified service business? Real estate agent, what do you guys think? I will tell you the answer. Yes, real estate agents are considered to be in a specified service business. Their principal asset is their ability to sell, and it might be their, combination of that and their knowledge of the market, their reputation in a given market. So the catch applies to them, right? So they can't make too much money, or they're going to not be allowed to take the pass-through deduction. How about a house flipper? What do you guys think? Are these? Is this a specified service business? The answer is no. House flippers are not considered to be in a specified service business, although there is certainly an element of skill to a house flipping business, just like there's an element of skill and possibly reputation in any business. The principal asset of a house flipper is their inventory. It's the houses they buy. That is their principal asset. And so the catch does not apply to them. Kind of the same thing with landlords. Landlords are not considered to be in a specified service business. Their principal asset is their property. So quiz time. You're a real estate agent who nets $100,000. Can you take the pass-through deduction? And the answer is yes, because you make below those specified amounts, right? 157,005 if you're single, 315K if you're married. So you can take a full pass-through deduction. Now, you're a real estate agent who nets $500,000. Can you take the pass-through deduction? Answer is no, because you're over those threshold amounts. Too bad, so sad, game over. You cannot take the deduction. You're a landlord who nets $100,000. Can you take the pass-through deduction? The answer is yes. As insofar as this is really a bona fide trade or business, you have to have. Most professionals believe that you must have some, activity in the business. You must, participate in the business to some degree. So if you're like purely passive in an investment, that may not rise to the level of an actual quote unquote business for the pass-through deduction. But if you have a few rentals around town and you're actively managing them, so you can very, very likely take the pass-through deduction. There's a little gray area with landlords because it's kind of in between an investment and a business. So talk with your tax professional about whether or not your level of involvement in your real estate business qualifies. But if you're a landlord who's netting after deductions $100,000, you probably have a decent portfolio. And assuming you have some say in that the management is not purely passive, you will likely take the pass-through deduction. Now, similar thing, but let's say you're the same landlord who nets $500,000. Can you take the pass-through deduction? It depends. Okay, you're not excluded from it because you're in a specified service business, because you're not in a specified service business, but there is another catch here, and we're going to talk about that now. So catch number 2 is the pass-through deduction is limited to the greater of 50% of wages paid or 2.5% of the depreciable property used in your business. So let's give an example. Jack is single. He has a house flipping business that he operates in an S corporation. After taking a $150,000 salary, he nets $500,000. Okay, so really his business made $750,000 or $650,000. He took a $150,000 salary. He nets $500K. If not for these catches, right, Jack would get a $100,000 pass-through deduction, 20% times his net, $500,000. Right? Let's go back to catch number 1. Is flipping a specified service business? No, it's not. It's not. So catch number 1 doesn't apply. So now we go to catch number 2, right, which says the pass-through deduction is limited to the greater of 50% of wages paid or 2.5% of depreciable property. So let's ask ourselves, does Jack's business have depreciable property? No, it does not. He's a flipper. It's inventory. It's not depreciable. So we only look to this wages paid limitation, this one here, 50% of wages paid, to determine this catch number 2 amount. So Jack, as we said, Jack took a $150,000 salary. 50% of $150,000 is $75,000. So that his pass-through deduction is limited to $75,000. So instead of a $100,000 deduction, Jack only gets a $75,000 deduction. So kind of a takeaway here is work with your tax professional. Like if you have some wiggle room with your salary, considering also the fact that salary is subject to FICA tax, payroll and our Social Security and Medicare, but then you kind of also got to balance it with this pass-through deduction. So, that's some opportunity for you to get with your tax professional and to kind of talk through the numbers. So this makes Jack very sad. He's crying about his pass-through deduction being limited. So let's give another example. Diane is single. She owns an apartment building and an LLC. She purchased the property for $2.5 million. $2 million was allocated to the building, and $500,000 was allocated to the land. After all expenses, her property generates $500,000 in net income. So if not for the catches, Diane would get a $100,000 pass-through deduction, 20% times $500,000. Okay, let's go back to catch number one, see if that catches her. Is landlording a specified service business whose principal asset is a skilled reputation to one or more of its employees? The answer is no. So catch number one doesn't apply. So now we go to catch number two. The pass-through deduction is limited to the greater of 50% of wages paid or 2.5% of depreciable property. Does Diane's business have wages? Let's assume not. It's possible she, might pay maybe a live-in property manager or something, W-2, but let's just assume not for sake of example. So we only look to depreciable property to determine catch number two. Now, Diane's building basis is $2 million, right? So 2.5% of her basis is $50,000. So instead of a $100,000 deduction, she only gets a $50,000 deduction. Just like Jack, Diane is very sad. She doesn't have enough basis. Her pass-through deduction is limited. But you got to admit, when it comes to first world problems, not taking as, having a limited pass-through deduction is probably pretty high on the list, right? So, depreciation, we're going to move on from the pass-through reduction and talk about depreciation, bonus, and Section 179 expensing. Again, I know that pass-through reduction was hairy, right? Book me for a free consultation, alexcpa.com/free30. It's at the bottom of the screen here to talk through it about your situation. So depreciation, current depreciable lives, these have not changed. Due to tax reform, right? You got your residential rental, 27.5 years, non-residential real estate, 39 years, your land improvements, 15, appliances, 5, equipment, 5 to 7, cars, 5 years. This isn't very exciting. Lives haven't changed, but so here's the deal. And a lot of you guys probably know this, but with depreciation, in a sense, it sucks that you're going to have to wait, this amount of time to get the full tax deduction. Right, for some of these things. So, let's say you buy an appliance, it sucks. You have to wait 5 years to get the benefit, right? Because if you got all that tax deduction today, you would have a lower tax liability today. That's more dollars in your pocket today that you can invest. There's a time value of money concept here, right? A dollar today is worth more than, a dollar in the future, theoretically. Due to inflation and also due to the rate of return you can get on that dollar if you had it invested rather than paying it today to Uncle Sam. So generally, given that fact, investors want to accelerate the depreciation, right? Because a dollar today is worth more than a dollar 27.5 or 39 or 15 years from now. So there's this provision in the tax code called bonus depreciation that lets taxpayers accelerate their depreciation deduction. And we're going to talk about, what that acceleration is here in a second. But you can't do it with all your assets. The assets have to have lives of 20 years or less, and there have to be some eligibility, requirements. And we're going to talk about that. So, what kind of assets are eligible for this accelerated bonus depreciation? Well, the old law said it had to be new property. Right. So it had to be new property. So, this is beyond the scope of this presentation, but, when investors, they buy, let's say, an apartment building or a big commercial building, something they'll do is called a cost segregation, where, they'll pay a cost segregation firm, typically, engineers work there, and the engineers will come out and basically divide, the building as various pieces into, different types of property. So, let's go back to this earlier slide. I know this is a rabbit trail, but I think this is useful. So, let's say you buy an apartment building, right? Typically, you'd have to depreciate that. You split between land and building. Land, you don't get to depreciate. The building portion, you'd have to depreciate over 27.5 years, right? That's a long time. let's say you want to accelerate your depreciation deductions. You can pay a cost seg firm to come in and say, okay, so a certain percentage of this building we can call land improvements, right? Like maybe some of the exterior, land, improvements like a fence or a, paved, walkway outside or the paved parking lot, right? We can call that, 15 years. So you get an accelerated deduction, right? Instead of waiting 27 and a half years, you get 15 years to you can depreciate over 15 years. So that's more deduction every year, more money in your pocket every year to invest or do what you want with it. And they'll say, some of the, a portion of the property is, 5 years, right? Maybe a portion is 7 years, right? So what they do is they'll prepare this report that says, this, the X percent of the property we can call 15-year property. X percent of the building, we can call 5 year. X percent we can call 7 years. So the owner, the landlord, gets an accelerated appreciation because based on this cost segregation report, he or she can now depreciate items within the building faster. Now, obviously, still the majority of the building will be 27 and a half years, the building structure and all that. But typically a good enough portion, is accelerated to these shorter class lives to justify the cost segregation study. So let's come full circle. Let's go back to the bonus eligibility rules. So, previously, to take bonus on an asset, it had to be new property. So that means if you bought a building and you did a cost segregation study and it was divided into all these components, even those components may have a useful life of 20 years or less, you couldn't take bonus on those cost segregated assets because they were not new property. They were old property. They were there when you bought it, right? New law says, this property, you can take bonus on whether it's new or used. So this is really great for cost segregation, because now you can take bonus on those shorter class live properties that you previously couldn't. This is kind of advanced, kind of a rabbit trail here. Not your fault if you didn't follow along. I actually didn't plan to talk about that, but just know that this bonus, if you're into big apartment buildings, big commercial buildings, that this new bonus provisions and kind of the interaction with the cost segregation rules is a pretty big benefit. So, we said that these certain assets that are eligible for bonus depreciation get an accelerated depreciation rate. What are those rates? Well, under the old law, for throughout 2017, there is about 50%. It's 50% bonus depreciation, right? So let's say you bought some equipment for your business. You paid $1,000. You could take a 50% deduction right in the year you bought it. So $500 deduction. The remaining $500 basis, you'd have to depreciate over 5 years because that's what you depreciate, equipment over typically. But now under tax reform, you spend $1,000 on that equipment. Now you can deduct it just like that in year one. $100,000, that $1,000 piece of equipment for your business, you can take $1,000 deduction right off the bat. So, and they kind of extend the rates out, many, many, many years. Kind of interesting, kind of not. So, now, as many of you know, if you're landlording, you have to, buy a new apply a fridge or something for your property. There was this old $2,500 de minimis election on personal property. It's still around, but it may be less relevant due to the 100% bonus depreciation. There's also Section 179 expensing, which also allows you to deduct 100% of the cost of the asset. It used to be $500,000 in 2017. Now you can deduct up to $1 million of purchases, but this Section 179 is really targeted at smaller businesses. So if you're putting in more than $2.5 million of Section 179 eligible assets during the year, your Section 179 expense will be limited. So the focus for 179 is on smaller businesses. So there's obviously overlap between bonus depreciation and 179. 179 does have some more rules to it. Like, you can't be in a tax loss and take 179. So bonus is kind of the go-to. But one kind of cool thing about 179 is that you can now take it on certain components of non-residential real property, such as roofs, fire alarm and security systems, and HVAC systems. So, this is pretty awesome. Now, this only applies to non-residential property, okay? This doesn't apply to your apartment buildings, doesn't apply, to your rentals or any of that. It's eligible for certain components of non-residential real property. So you have these roofs, fire alarm security systems, HVAC systems. You can deduct up to $1 million of purchases on those. So that's unique. We've never seen that before. As I kind of mentioned previously, unlike with bonus depreciation, your business must have a profit to be eligible to take Section 179 expensing. So I think that's it for depreciation. Now I got to give you guys a trigger warning because, up until this point, we've talked about some pretty cool things, right? We've talked about the things that make us happy. We've talked about the lower tax rates. We've talked about the expanded child tax credit. We've talked about the pass-through deduction, the 20% pass-through deduction. We've talked about bonus depreciation and things like that. So these things have all made us very happy. But now we're going to talk about some things that might distress us, might make us sad. So I got to put out this trigger warning so that, just be prepared to be offended, okay? First kind of sad thing that we're going to talk about is the meals and entertainment deduction. I love spicy food. I love taking clients to go eat spicy food, but some of these deductions for my spicy food are going to be limited now. So here's a little chart of the rules for meals and entertainment between 2017 and 2018. This is a chart of pretty much everything that was what do you call it? 50% deductible under the old rules. So the first three there: in office, employee meetings, business travel meals, client event meals. Those remained. Those were not changed. But entertainment meals, right? Which is, you take your client or something out to, a club or a bar, a cocktail bar or something, and you're not really talking business, and you could still deduct 50% of that, even though it's pretty much strictly entertainment, not so much business. But in 2018 that's 0%. Sporting events, you take your client to the ball game or whatever you like to watch, the tennis match, or you're not really probably not talking a whole lot of business there. You used to still be able to deduct 50% of that. Now it's 0%. Oh, also under entertainment meals and sporting events, golfing, right? So golfing, you take your client out to the golf course. Used to be a 50% deduction. Now it's a 0% deduction. Client dining. So let's say you're not at a golf course, not at a some like cocktail bar. You're just at a normal restaurant. It's not extravagant. You used to be able to take a 50% deduction. Now, I believe, based on a very little reading of the Tax Act, that's now at 0%. Some practitioners believe that no, that is not the intention of this. If you take your client out to, a restaurant and you're still talking business primarily, right, that you should still be able to take that a 50% deduction for the food. Right. And that's the distinction between this client dining and I'm going to say entertainment meals, right? Entertainment meals is maybe you're not talking business, or it's just in a setting where you're obviously not talking business, like, a club, for example. So some practitioners do believe that for, client dining, just like in a restaurant, you're talking business, that there's still a 50% deduction. But I believe, based on the literal reading of the tax code, or the tax reform, that goes down to 0%. But I would not be surprised if the IRS issued some guidance, stating that it's actually 50%, because obviously this is tough. This is tough for a lot of folks. So let's see what's next. Okay, so all this is stuff that used to be 100% deductible under the old rules. Office holiday party, transportation to business meals, public seminar meals, employee convenience meals, office snacks, charitable events. Not sure how much this applies, to a lot of you real estate investor folks. But you have let's say you have a brokerage or something. You throw a holiday party for your employees. That's still 100% deductible. Transportation, a taxi or Uber or whatever to a business meal, that's still 100% deductible. Public seminar meals, still 100% deductible. That's if you hold like a seminar or something that's open to the public. You can deduct 100% of that. Employee convenience meals, you have an so these are meals for your employees that you provide for your benefit as their employer, right? So if you have, employees, they have to work late, right? You want them to kind of stay in the office and work, and you bring food for them. And so that is, that's still deductible, but it's no longer 100% deductible. Now it's only 50% deductible. Office snacks, 100% to 50%. Charitable events, and by charitable events, I mean like golfing, and so like a charitable golf event or something like that. You used to be able to write that off, but now that's a 0% deduction. So, okay, yeah, here it is. Some practitioners believe that a 50% deduction for meals with clients in which, business, I phrase this weird, but it should say some practitioners believe that a 50% deduction for meals with clients in which, business is the primary topic of conversation. Some practitioners believe that has been retained. However, based on literal reading of the Tax Act, I believe that this deduction was eliminated. But since this sucks, I would not be surprised if the IRS issued some clarifying guidance on this issue. Possibly just stating that if you take your client to a restaurant, not extravagant, not like a club or a bar or anything, just you're primarily talking about business. As long as you have that documented, that you might be able to take a 50% deduction. But we're just gonna have to wait and see. With the tax reform stuff, especially this meals and entertainment, a lot of it is kind of guesswork right now. And so we're really kind of waiting for IRS guidance. So that's enough about that. Let's talk about mortgage interest and state and local and property taxes. So you guys have probably heard this in the news, especially if you live where I live in California. The mortgage, so previously under previous law, you could deduct your interest on mortgages up to $100,000, and you could take out a home equity line of credit on your home up to $100,000 and use it for whatever you want. You could use it for a trip around the world, a ski trip. You could use it to pay for your kids' college. You could use it for whatever you want and still deduct it, even if it's not business related. 2018, however, for new mortgages, you can only deduct the mortgage interest on up to $750,000 of debt, and you can't just deduct your HELOC interest willy-nilly. But there are some caveats here, some favorable caveats. So mortgages, but not HELOCs, obtained prior to 12/15/17 are grandfathered in at $1 million, right? So this, if you had a $1 million mortgage, obtained before this date, you can still deduct the full, interest on that to the extent that's your only residence, right? But if you got $1 million mortgage after this date, 12/15/17, then you can only deduct the interest up to $750,000 of your debt. So that's that. Limits, and of course, these limits on the HELOCs, okay, limits on HELOCs do not apply if loan proceeds are used for business or investment. So, let's say you get a HELOC, right, and you get all the proceeds in a certain bank account, right, and that bank account is just used to fund a business or to buy a rental property or something. You can deduct the, you got to trace that interest and deduct that interest because it's, you've traced it to a specific business or rental property. But if you get that HELOC and, it's just in your personal bank account and it's all kind of mingled in with your other funds and you pay, who knows what out of it, right? That's not going to be deductible. That used to be deductible, up to $100,000 of your line of credit. But now it's, that kind of personal use of HELOC proceeds or undocumented use of HELOC proceeds that's not deductible. So, but if you can trace it, set up a separate bank account, for the HELOC money and then just pay business expenses out of it. Maybe go buy a rental property with the HELOC or, who knows what you do. If you can trace it, kind of get that paper trail going and show that this interest, these proceeds were used for business purposes, you can deduct that, interest as business interest. And there are some limitations there, but that's beyond the scope of this, for business interests in general. Not specifically HELOC interest, but that's kind of beyond the scope of this presentation. So, if you have if your refinances of grandfathered mortgages retain the $1 million limit, but only to the extent of the debt balance at the time of the refinance. So, let's say you had a mortgage, right? Let's say it was originally $1 million, and fully deductible, and then the loan balance went down to $600,000, and then let's say you refied it for $600,000, so that, or let's say you refied it for let's say that the debt balance went down to $800,000. You got to refi, for $800,000 new loan. That still retains the old $1 million limit. However, if in that refi you cash out more than your your loan balance, then that portion is subject to the limit. So that's how those rules work with the refi. So refinance of the grandfathered mortgages retain the $1 million limit, but only to the extent of the debt balance at the time of refinance. Not the original debt balance, but the debt balance at the time of refinance. And of course, as you probably all know, the aggregate itemized deduction for state, local, and property taxes is capped at $10,000 per year beginning in 2018. So, you add together all your state taxes, all your local taxes, all your property taxes, and you can only deduct $10,000 of them as an itemized deduction beginning in 2018. Of course, this does not apply to business or investment taxes. So we talk about some miscellaneous itemized deductions now. This affects probably fewer people than the other stuff we've talked about. But basically, previously, you could deduct miscellaneous itemized deductions in excess of 2% of your adjusted gross income. So there's these deductions called the miscellaneous itemized deductions, and we're going to talk about a list of them in a second. But to the extent that they exceeded 2% of your income, you could deduct them, right? So let's say your income was $100,000. 2% of your income is $2,000. Let's say you had $5,000 worth of these deductions. You could deduct $3,000 of them. But as of 2018, these deductions are gone. Okay, so what are these kinds of deductions we're talking about? Tax-free fees, investment expenses, unreimbursed employee expenses, loss in IRA accounts, trustee and legal fees, job search, all gone. Zip, zilch, gone. Not much to say here, so we're going to move on. 1031 exchanges. This was on the chopping block, I think, originally, maybe in the House version. I'm not sure. I know it was in the chopping block originally. We're going to get rid of it. Altogether. I know there's a lot of qualified intermediaries maybe out there watching this. They're like, oh my gosh. But thankfully, you can still use them for real estate. However, they are no longer allowed for non-real estate. For example, vehicles, equipment, machinery, aircraft, boats, cryptocurrency, etc. So time periods remain the same. Those are unchanged. Identify the replacement property within 45 days of sale. Close the replacement property within 180 days of sale. So that's pretty straightforward. One thing for you California folks out there, watch out for the California clawback when you do 1031 exchanges. So, let's say you bought a property, for $500,000, and now after depreciation, your basis is $400,000. You 1031 into a property out of state. So that $100,000 of gain that was quote unquote earned while the property was in California, or I guess I'm missing a piece. Actually, let's say now you sell it for $600,000 and exchange into a property out of state, right? So originally bought for $500,000, appreciated down to $400,000, sold for $600,000. There's a $200,000, assuming this is a California property, there's $200,000 of California gain, right? Even though you're not paying it yet because you deferred it through a 1031 exchange, there's $200,000 of California gain that California wants you to track and file a form with your tax reform every year, such that when you eventually sell that replacement property out of state, you come back to California and pay tax on the gain that was quote unquote earned on the original property in California. There's some other rules here, kind of complicated. There's a separate form you got to file. Lots of CPAs miss this because they're not, in real estate specific. So if you're thinking about doing a 1031 of California property to out-of-state property, we got to talk. You can book me at alexcpa.com/free30. Now we're going to talk about the AMT, the dreaded AMT. So I know many of you out there have been subject to this. I have been subject to this. It sucks. It's not fair. Wah, wah, wah. But lo and behold, the AMT has been butchered. Its mighty sword has been dulled. it has been reduced significantly beginning in 2018. Just to give you some perspective here, in 2017, about 5.25 million taxpayers were subject or will be subject to the AMT. 2018, that number is about $200,000 or 200,000 taxpayers, right? So that's huge. Far fewer taxpayers are going to be subject to the AMT in 2018 than were previously. So, a lot of you have probably heard of AMT. You see it on your tax return, but you don't really know how it works. So let me explain to you how AMT works. So AMT is basically, AMT standing for Alternative Minimum Tax. It's basically a separate or alternative tax system where you don't get certain deductions, right? Such as state and local property taxes. That's a big one, right? And so what you do is you compare your tax liability under the AMT rules to your tax liability under the regular tax rules. And if the AMT tax rules result in a higher tax liability, you have to pay that amount instead of your regular tax calculation. And also the rates are different under AMT. I think I have the chart here. Right. So, let's say you're single. So these are kind of your AMT metrics or factors here. So, you're single, right? Your income, your AMT taxable income, 26% rate begins at $0 and your 28% rate begins at $187,008. AMT only has two tax rates. One's 26%, one's 28%. There's also this exemption amount. So a portion of your income is exempt from AMT, right? But then that exemption amount gets phased out, and the phase outs are there. So as you can see, in 2018, although the 28% rate begins at a lower amount, the exemption amount is increased, and this is kind of the big thing here that's changing AMT. These phase out amounts, right, which previously, hit, I would call squarely middle class, maybe this is kind of getting to upper middle class folks. Now these phase out amounts where you start losing this exemption amount, these amounts have more than doubled, right? I would say that, you have to be squarely upper class now to really worry about getting your phase out, your AMT exemption phase out, starting at 500,000 single, 781,200, when that phase out is complete. Here's married, right? Kind of some similar things here. We're going to walk through. This is confusing, I know, and it's hard to explain without an example. We're going to go through actually an example here pretty quick that'll hopefully kind of explain what all these mean, because I'm sure this is all kind of gibberish to you right now. So let's go through the example. So, and hopefully that will shed some light on this. I mean, this is confusing. Even a lot of accountants don't really understand how AMT works. They kind of just trust their tax software, but you're going to be smarter than them. Okay, so example, let's say you're married, right? And this is your regular tax. You're on your 1040, your regular tax scenario. We're not talking about AMT now. We're just talking about your regular tax liability under regular tax rules. Let's say you're married. Between you and your spouse, you made $300,000 in 2017. Your personal exemption's $8,100, right? $40.50 each. You can deduct $25,000 state and property taxes. $15,000 mortgage interest, right? So your taxable income is $251,900. You run the that through the tax calculator, that gives you a tax liability of $58,000. 2018, right? $300,000 wages. You don't get any personal exemptions. Your state and property taxes are now capped at $10,000. $15,000 mortgage interest. Taxable income $275,000, right? But thanks to the lower tax rates, you're actually paying a little less. So $55,000. Regular income tax. Okay, now we're kind of getting into AMT territory. Okay, so in this slide, we're calculating what is your income for AMT purposes. Your alternative minimum taxable income is what they call it. So you start with your regular income, your regular taxable income, and then you add back exemptions. That doesn't apply for 2018, but for 2017 it did. Then you add back your taxes, right? Your state and local property taxes that you deducted for regular tax purposes. And that gets you your AMT income, okay? And these two scenarios, it's the same because, this exemption that changed between 2017 and 2018, that doesn't apply for AMT. And the state and local taxes, you can't take those for AMT either. So basically it's the same between 2017 and 18 for this individual married couple. So this is the AMT income. Okay, now on this next slide, we're going to calculate the phase out of the exemption. So how the exemption works, let's go back to the slide here. how the exemption works is you take your AMT income and then you reduce it by this exemption amount, right? And whatever that amount is of your AMT income after the exemption amount, that's the amount that you subject to these AMT rates. Okay? So, but this exemption amount gets phased out after you make a certain amount of money, and you can't take any of this exemption at a certain income level as well. So, for every dollar, this is 2018 rule. So for every dollar you make over the phase out, when the phase out begins, you reduce your exemption amount by 25 cents. So you don't have to worry about all this math. I'm going to kind of show you how this works on the slide here. So where are we? Phase out. Okay, yeah. So this is their AMT income, right? We calculated here 285,000. The phase out begins for a married couple in 2017. Let's go back to the other slide. The phase out begins at 160,900. Right? So if you make more than that, then you're gonna lose some of your exemption. So this is the phased out income. So this was the excess of your income over the phase out threshold. You basically divide that by 4 because the exemption gets reduced by 25 cents on the dollar for every dollar you make over the phase out threshold. Right? So the statutory exemption, which is written in the tax code, it's 84,500. You got to reduce that amount by your phase out amount. So your allowed exemption is only 53,475. Okay. 2018, this phase out is so high, right? Married couple, they have to make $1 million before they have to worry about the exemption phase out. Okay. So they get to take the full statutory exemption of $109,400. So here's how this works, right? They take your AMT income, $285,000. You subtract the allowed exemption, this bottom line here, right? And that gives you your after exemption AMTI, okay? So you can see that that is a much lower amount in 2018 and 2017, partially due to the fact that just the exemption amount increased, but more so because the phase out for the exemption, increased by so much. A married couple only had to make $160,900 before their AMT exemption started phasing out last year, right? I mean that's like 2 people making $80K, right? That's not wealthy by any means. But now, it begins at $1 million, and that is that's huge. That's huge. Like obviously, if between you and your spouse you're making $1 million, I mean, you're doing pretty well. So these are the after exemption AMTI amounts. So now we figure out the rates. So this how much of the income is subject to the 26% rate. This is set in the tax code, right? And we had a slide over here before. 26% rate goes all the way up to 107,800. 2017. 28% rate goes all the way up to 191,500 in 2018. So we're going to take those amounts, put them over here. So 2017, this amount is subject to the 26% rate. This 48,000 is this amount, 187 times 26%. And then the difference between 231 and 187.8 is this 43,725, which is subject to the 28% rate. Here's a tax at the 28% rate. This is your what's called your tentative minimum tax, right? Which is basically the tax under the AMT rule, 61,071. 2018, because of that, expanded exemption, your AMTI is a lot lower, and so all of it's only subject to 26% rate, 45K tentative minimum tax. Right. So now you compare your regular tax to your tentative minimum tax, right? And, if your tentative minimum tax is greater than regular tax, you are in AMT. So in 2017, these folks' regular tax liability was $58,000. Their tentative minimum tax was $61,071. So they're going to owe AMT tax of $3,071. 2018, they're nowhere near being in AMT. So this along with the pass-through deduction is probably the trickiest to explain because there's this phase out and this exemption. It's actually mechanically probably more difficult to follow than the pass-through deduction, but A few questions about this. If you've been in significant AMT in the past and you want me to run some quick numbers about, what you can expect for 2018, go ahead and book me, alexcpa.com, free 30 for a free 30-minute consultation. Okay, now we're going to talk about some random stuff that is, doesn't kind of really fit anywhere, but it's just kind of a hodgepodge of stuff. So no more casualty and theft losses. So previously, if your house burned down and, to the extent that what you lost was greater than the insurance payout, then you could take a casualty loss. But that's no more, except for losses in federally declared disaster areas. All the more reason to have adequate insurance. Okay, I hope and pray that something like this doesn't happen to you, but just make sure you're insured, right? Like here in Southern California, we had these fires, and there were some in Northern California too last year, but there were fires last year, and people lost their homes, they lost everything. If they weren't insured, what a nightmare. And even if you're insured, what a nightmare. Because sometimes these insurance companies, they can they can be non-responsive or try to whittle your claim down. But anyway, just get insurance. Talk to your insurance agent. So you have the coverage you need. Okay, deduction for moving expenses is suspended. So previously, it's kind of a weird calculation. If you moved, and there's a 50-mile rule, if you moved a certain amount for work, you could deduct some of your moving expenses. That's gone. Also, if you got reimbursed for moving expenses from your employer, that was typically tax-free. But now, unless you're in the armed forces, you got to include those reimbursements in your income. Alimony deduction is now suspended. And there's no longer taxable income to the recipient. Gambling losses, previously professional gamblers could have taken gambling losses, in excess of their winnings, but now they can only apply losses against their winnings. I hope this doesn't apply to any of you. I hope you're none of you out there are professional gamblers, but if you are, know this. Also, 529 plans can now be used for private schooling as opposed to only state. The medical expense itemized deduction floor is back at 7.5% of AGI, previously 10%. So this actually goes back to an old rule. In 2017, you could only deduct itemized deductions to the extent they exceeded 10% of your AGI. You made $100,000. Medical expenses had to exceed $10,000 before you could deduct them. So make $100,000, had $12,000 of medical expenses, you can deduct $2,000, right? Make $100,000, have 10% or have a $7,000 or $9,000 of medical expenses, couldn't deduct any in 2017, even if you itemize deductions. 2018, that floor is at 7.5%. So you make $100,000, you had $9,000 of medical expenses, you can now deduct $1,500 of those if you itemize your deductions. So, and that was actually the old rule before tax law changed a few years ago. Did I double up on this slide? I sure did. Okay, and then last but not least, and this is actually a huge deal, right? But we're not talking about it a lot here in this presentation because most of you are not C Corps, right? So now there is a 21% flat tax rate for C Corps. Used to be graduated rates from 15% to 39%, with the highest incomes at 35% rate. But all C Corps are now paying a flat 21% tax on their income. So this is huge. For Wall Street, you see all these companies giving bonuses or whatever to their employees. A lot of these companies, their taxes are going down significantly. So, I guess a takeaway here is, there's something for Wall Street in here. There's definitely something for Main Street, right? Small, self-employed business or, small business, right? With that pass-through deduction. There's something obviously for maybe kind of lower income folks who don't have a lot of assets. Maybe they don't own a home, right? Because they get that increased standard deduction. There's something for everybody. But maybe the type of person who doesn't get as huge a benefit is, like the W-2 wage earner, right? Especially if they're in like a high tax, high property value state like California. Yeah, your rates are going down, of course. But, kind of that W-2 wage earner is probably not getting as big a, but they're still getting a benefit probably, but probably not as big a benefit. So, but there is something for everybody. And questions, if you have questions, you can post them in the comments below. on the YouTube video. That wraps up the presentation. I just want to say thanks if you made it all the way through. I know taxes isn't the most exciting topic, but thanks for watching. If you want to book me for a free consultation, alexcpa.com/free30. I have clients around the country. While I am in the Los Angeles area, I do work with most of my clients remotely, and it's a pretty seamless experience. So yeah, if you want to chat about your tax situation, how it's going to change to tax reform, alexcpa.com/free30. Well, I really enjoyed educating you guys on tax reform for real estate investors. Feel free to leave any comments below, and I'll see you in the next video. Bye-bye.